Let's be real here. Is whole life insurance just a big waste of money? Well, I mean, you got bills in your life, right? You got things like phone bills, you got cell phones, you got utilities, you got rent, or mortgage payments, you got all these things to pay for. Why do you want to have to pay more money to just waste away? Well, let's just dig into that right now. Talking about whole life insurance. Is it a waste of money? When can it actually be good versus when it's bad? And here are the 5 things that you need to know so that you don't waste all of your money on the whole life insurance policies. All right, first and foremost, people will start asking me, why are there fees on whole life insurance? It's simple, guys. You're not just paying for this tax-free savings account called cash value, right? Which I talk about, yeah, it pays you more than the bank at 0.nothing%. It pays you a lot more there. But people are like, yeah, but I have to pay fees into this. You do, because it's life insurance. Life insurance have fees, just like term life insurance. Now, I'll tell you, term life insurance is cheaper when you're young, gets more expensive as you're older, right? Which is why most people never keep it when they actually die. That's why less than 1% of all term insurance policies ever pay out. So insurance companies love for you to buy a lot of term insurance because they know they'll never pay out. That's the highest profit center for them, right? They're gonna make more money because they tell you that when you get old enough, cancel your policy. You don't need it anymore. You have enough assets. Get rid of your life insurance. And even if you try to keep that term insurance policy, it gets so ridiculously expensive when you're in your 70s and 80s that you don't want to keep it anyways, and they make all that money. They pocket all that money for themselves. That's why it's cheap. Whole life insurance up front especially is not cheap. There are the most fees, especially in those first 2 to 3 years. You will pay the vast lion's share of the fees right then. I remember when I bought my first whole life policy. Now, understand, I used to be a financial advisor. Yes, this guy was really a salesman in a suit that paid to sell you crap, not make you more money. I was that guy. I knew about life insurance and stuff. I knew about mutual funds because I sold all of the above. But I remember being interested in whole life insurance, which as a financial advisor, I said, whoa, hold on. That's a big waste of money. If you buy whole life, like you make no money in those accounts, you can make way more money in the stock market. So why would you put your money there? Well, as I started to leave that industry, I actually was able to retire when I was 28 years old investing in real estate. As I got to know a lot of these real estate investors, they were all raving about this infinite banking concept, right? Nelson Nash's concept. And I thought, okay, this is interesting. Why is this good? And they're like, oh, because you can do cool stuff with this and you can actually be your own bank. You could buy cars with it or buy houses and pay yourself back and all these things that maybe you've seen online if you've gone into this rabbit hole enough, right? Which, by the way, a lot of those things are actually lies, which we'll talk about in a second. If we don't talk about it, I still have other videos that talk about it too, if you subscribe and like on this channel here. But anyways, long story short, I said, all right, I'm interested. I looked at the numbers. I remember meeting with the agent. I said, listen, I'm insurance licensed, but I don't understand all this, but it looks good. It sounds good. Let's do it. So I committed to $1,000 a month to go into this policy. I remember seeing those first 2 years. I said, oh my goodness, I'm going to have zero cash in that account after 2 years. He said, yeah, that's how they all are. But look at year 3, most of what you put in goes in year 3 and then starts to build. Finally, after like 15 years, you'll have just as much as you paid into it and you have a death benefit. So it's like free insurance. Although that's kind of true, those first few years, it kind of sucks, doesn't it, right? Because you're paying everything to fees, especially if you get it from like your State Farm agent or whatever, And so I bought it. Now, just a few years later, because I was able to retire in 2006, after I bought that policy. Well, 2 years later, the recession hits. I'm going broke. I can't afford to keep paying this $1,000 a month. I had to let the policy go. Paid $25,000 into it, only to lose it later on. It was like the biggest waste of money ever, the biggest ripoff of whole life insurance, but it felt like term insurance instead because it was gone. So I said, this is bad, but oh well, that's just the way life is. Maybe I'll get one later. Well, a few months later, as I'm speaking with a friend of mine, we find out, because he bought a policy from the same guy, we find out, wait a minute, he could have actually adjusted the numbers to make it a little less costly. And I said, wait a minute. I asked him if I could do that, and he said no, because I knew I could do that with other insurances, but he said I couldn't do that with whole life. He said, no, you can actually adjust some of the numbers to where you could have money in there from day one, not wait till your 3rd year before you have a few bucks in there. So I confronted the guy about it, had a 2-hour debate. I mean, it was actually getting heated. I was yelling at this guy in this office. Even the assistants out there were like, they were freaking out. They're like, oh, I don't know. Should we break it up? What should happen? Well, after 2 hours and finally just telling him, no, it's not about the death benefit. Even though I even matched his death benefit. I got the same death benefit, more cash from day one. Finally, he just said, Chris, I did it that way because I couldn't afford to cut my commissions. And that's where I said, all right, well, you're never getting my business again. And by the way, I've sent you a lot of referrals. None of my friends or family are ever going to see you again. This guy is now out of the business. He now works for a bank because that's where people go when they screw people over. They go to banks, right? So anyways, over the last 15 years, I started trying to develop it better because you can actually adjust the fees. Unfortunately, 1, insurance companies don't really try to train you how to manipulate the system to where you pay less. And then 2, even if The insurance agents do understand it, which is the vast minority of insurance agents. The problem is most companies don't want to do it, and the insurance agent doesn't want to cut their commissions. And so you'll hear things out there, they'll say, well, you could do a 60-40 split where 60% goes to your cash and 40% goes to fees. And that's the best way. No, that's the best way for them to get the win-win, because they know they're charging you almost double the fees that you actually have to pay to do that. And yes, I'm calling out certain people here by saying that, but it's true. That's the whole reason I'm actually in this industry, is because I'm so pissed off that people are saying, no, this is the way it should be, or that's the way it should be. No, the way it should be is what's best for the client, which is how do you give them the most cash possible? Yes, they get a death benefit, which is awesome, but the way we design it is that the death benefit almost becomes icing on the cake. It's the ultimate purpose of insurance, but to have this tax-free savings account that pays for itself within a few years, that's pretty awesome. And so that's the big key factor. So if you don't want to waste money, don't buy the traditional whole life plan. And it's not even about the insurance company, because even people I've met that have done it with companies that I use, again, will start to rip you off by doing additional, really non-essential fees that you don't need. And that's what's so important. You got to make sure you don't waste all your money on this. You want to make sure that your money is working harder for you, so you have to keep working extra years to work hard for that money. Now, many people will say, well, why aren't those fees just standard? Why can't they just make it all the same? Well, the truth is that there's a lot of flexibility. Some people want a bigger death benefit right off the bat, and they're willing to pay more for it. So there's a need for that, right? Definitely an ability to do that. But the truth is, guys, like most of the clients I talk to, either one, they already have some death benefit, they already have some life insurance on themselves, and they're looking for a way to leverage their money better. Or two, they're saying, yeah, I want the death benefit, but I also know I can dump a lot of cash in this thing. And the great thing is, because people know that from day one, if they know that 75 to 80% of their cash can be available in their policy from day one. So that means if somebody puts in 20,000, they've got maybe about 15, 16,000 sitting in there. They're like, well, why not do more? Because almost all of my money is going to my own cash. I get to have control of my own money versus going to pay for the agent's commissions. So people do more. I had one client in particular, he actually owns a real estate company. He was putting over $6,000 a year into a plan. And I told him, I said, this guy is a moron. Like, you do not want to use this guy. He's just going to rip you off. Well, he used him anyways because the guy sent him a few referrals in business. It drives me nuts when business owners are like, well, he sent me some referrals. So you just took money away from your family to pay this guy? Not worth it. So anyways, he did the policy with the guy. 6 years later, my friend comes back to me. He says, hey, I've paid $37,000 into this and I only have $18,000. What a waste. And I said, yeah, that is. I told you, the guy's kind of a doofus, right? Like, don't use them. Well, when I showed him what was possible and how much cash he can have from day one, when only about roughly 20% or so of fees came out in the first year, he says, Chris, if that's the case, I'm going to put in $50,000 a year. So he starts putting in $50,000 because he knew he had $40,000 in there from day one, and that's the most expensive year. The year after that, he puts in $50,000 and only roughly about, he has about $45,000, $44,000 going in to build it up. And then the next year, he knows, like, he puts in $50,000, grows by at least $50,000 and so on. And so he's like, this is amazing. This is awesome. You know what's ironic is that just because he did that, even though I cut my fees down all the way they could go, I actually made double what that other insurance agent made. Why? Because it made my client more money, right? It made you more money. And as a result, I made more money. So that's the ironic thing, right? These guys live in scarcity and they try to do what's best for their pocketbook, but they ignore what's best for you. That's why we're in this industry, to try to disrupt it and change it and piss some people off. Even the people in our own industry are ticked off because we're even teaching this kind of stuff. So yeah, these fees aren't standard at all. They are standard to a degree, but we can use and manipulate these numbers based on what we've learned and tested over time to get it to where you get the best ROI every single time. Now, which companies are best? Like I said, the companies is not always the companies, but I'll tell you, mutual companies in general are usually better than stock companies. This is why MetLife doesn't usually have a good one. Also, companies that don't focus on whole life insurance specifically, if that's not their main thing, you probably don't want to use it, right? There's a lot of companies like Prudential that really don't care about whole life, AIG and those kind of companies too. So there's companies like Mass Mutual, there's Penn Mutual, I'll tell you, Northwestern, although they're known for it, very expensive, kind of a waste of money. You will get ripped off there every time. Every time somebody says, I'm looking at a Northwestern policy, we're like, we're going to beat it every time. So anyways, there's lots of different companies you can be using. Guardian, there's a lot of good companies out there. But again, it's really about how the agent designs it, not so much about the company itself. It's about how we can manipulate it and really depending on the situation. There's some situations I might use Mass Mutual instead of Penn Mutual or vice versa, right? It just depends. So how do you get multiple quotes on policies, or how do you know if you're getting the right thing? Get multiple quotes, right? And shop it around. This is why we give you numbers. By the way, key tip, if somebody does not give you the numbers after you have a meeting with them, don't use them. The only reason they're not giving you the numbers is because they're scared to death that you're going to shop around, because they know for a fact you will beat their numbers and they don't have to shop around that way. So shop around. I encourage it. Get multiple quotes. Make sure that they're apples to apples, that they're actually running the same exact numbers, but seeing how it works. I'll tell you, I had one client do that. And this is actually after they already bought policies over the previous 7 years. This couple was putting in $150,000 a year to these policies. And as we looked at them, there's like 4 different policies they had. First, I thought it wasn't even worth looking at. But as time went on, they said, Chris, can you at least check? Can you at least double check to make sure that these are doing the right thing? That these are working the way that we want, especially if we want to use these for investing and infinite banking and things like that and use it to buy real estate. So I looked at them. I did an apples to apples test on it. I had to run it a couple times because I was shocked because apples to apples put in the same numbers, even though they paid their costs up front with that policy, and now the costs were down lower, they still weren't low enough. And so even by doing a brand new policy with new fees, we were still in 20 years able to beat the number projections by $2.25 million, $2.25 million difference based on just what they were doing. Same dollars out of pocket, no difference, just doing it with a better design. And by the way, this guy was a popular infinite banker. And I said, you know what? I'm shocked. Now we kept one of their policies. One of them was actually good. The other 3 weren't. So we replaced those, moved their money over, and their money's working way harder right now than they ever would have had with that other company. So the only way to do it is you guys got to shop around. If you guys want to have us kind of compare numbers and see what works and see really, can we do better? By the way, if we can't do better, we'll let you know. If somebody that you like does exactly the same way we would do it, we would tell you. We'd be honest and say, hey, they look great. No need reinventing the wheel. Let them do it. But if we can do better, let us throw our hat in the ring to see if it could be. You can just go to moneyripples.com. There's an infinite banking section, and right there you can book a call with somebody to actually have numbers run with you right there on a Zoom call. You can see the numbers, and you can even get the numbers emailed to you so you can actually see them. So I challenge you to do that today, especially if you want to make sure that you don't waste all your money in crappy fees that aren't worth it. You and your family deserve better. Be sure to do that right now.